Hi everyone. You should have read already the material in your textbook regarding differential analysis, but I thought I'd pull together a quick PowerPoint presentation with a few things to highlight, some examples, some other resources that you might find useful. So here we go. So here I just extracted the definition of differential analysis from your textbook. Really what it comes down to is setting up the economics in two columns for one alternative versus the other. But technically, it makes reference to something called differential revenues, which is right here, and also differential costs. And so we're going to take a look at those things on the next slide. So differential revenue is defined per your textbook author as the amount of increase or decrease in revenue that is expected from a course of action compared to an alternative, while differential cost has the same definition, except this time it's focused on the cost. So think about differential as difference. The reason I prefer the term differential analysis over incremental analysis is because it leads you to think about differences between revenues and costs and corresponding profits. Okay, a couple other things. You should have learned about sunk costs already if you took an economics or a business class, but if you haven't, these are important things to think about, virtually ignoring. And I have done a lot of consulting work for venture capital firms, worked for some very bright and accomplished people, and they don't seem to understand the idea of a sunk cost. So sunk costs have already happened and you cannot recoup them. I think that's an important thing here. So for example, in the world of venture capital, oftentimes we're going to go ahead and have one of our portfolio companies, our investments, raise capital, and the partners, some will say, well, we've already put $5 million in, so we need to take that into account. And actually you don't. That money is gone, it's already there. You want to think about whether the next investment makes any sense. In a lot of ways, we talk about to the investor group about if this was a brand new deal with these economics, would you do it? So therefore, you need to ignore the money that was already put in, which represents the sunk costs. And then here, the idea of an opportunity cost is if you put the money to use in a specific opportunity, whether it's a new business line or product segment, the question comes is, in what could you have done differently? Where could you have put the money other than in that opportunity? So that's the idea of an opportunity cost. Really, there are lots of them, infinite numbers if you think about it, but corporations face this a lot as to whether or not they're going um, to put money into an alternative A, B, C, D, and there's lots of different opportunities for companies with a big footprint in their marketplace. I created something called a thing link, and it's something that I learned about in my graduate education program. I think it's really cool. There's a screenshot here, right here, that shows once you click on the link here, you're going to be brought to this page, and you can click on and you should click on these three videos, and there's a little bit of a short article here to get some different perspective. One of the videos, I believe it's the one in the bottom corner, is was the audio quality is not that good, but it's from one of my colleagues I met at a conference that I try to go to often, called Tactic, the Teachers of Accounting at two-year colleges. And she really was on the cutting edge of using videos in her instruction. So it's really informative, excuse the video quality, but this won't take you long. Go ahead and get through these different things, then proceed to the next slide. Here is an example of differential analysis, and similar to one of the thing link items that I included. And see here you can see what I talked about before, which is putting alternative economics. For this case, do you make it or do you buy it and then a differential amount? What you want to really hold on to here is to take a look at these fixed costs. Now I know this there's no footnotes for A and B here. It's just taking a look at how it's organized. But here you can see that there must have been something here that could have been avoided as far as production supervisor salaries if you buy it. Maybe you're going to cut back your production supervisor, or maybe you'll lay one of them off if you decide to buy it versus make it. But there are also many things that you cannot avoid even if you do buy them. So these are on the fixed cost components. Now all the variable costs could be avoided if you buy it. And then of course increasing one variable cost, which relates to the purchase of that amount. Again, you don't get to see the details behind that number, but that's not the purpose of this slide. And finally here, I'm leaving you with a pre-assignment exercise. It's pretty quick. You can use the material in your textbook to help you figure it out. You can use the information gathered in the thing link or on the previous slide where you organized where I showed an example of organizing a make versus buy. But I want you to go ahead and take out a piece of paper and pencil and solve this and bring it to the first class. It's not going to be graded based on accuracy. I'm just going to see if you made a reasonable effort and you pulled it together and it's complete. And then what I'll do is I'll walk around the class and first thing and check to see that you did it, give you credit for that. And then you're going to be working in small groups or individually, you'll have a choice, on some more exercises. So hopefully you learn what you need to out of this out of this PowerPoint. You accessed and read the appropriate pages from the textbook, and you should be ready to go for us to do some work together in class when we start unpacking further the idea of differential analysis.